Now the eighth accounting principle is matching concept or matching principle. According to matching concept, expenses incurred in an accounting period should be matched with revenues. Means the expenses and the revenues both should be matched, earned during that period. Thus, the expenses and revenues must belong to same accounting period, and the expenses and revenues that are to be matched should belong to the same accounting period. Determine the correct and this is done to determine the correct profit of that period. Since the accounts are prepared on accrual basis, so expenses incurred in an accounting period are matched with the revenue. As we prepare the accounts on accrual basis, therefore it is important to match the expenses with the revenue of a particular period of particular accounting period. Following points should be taken care of. Number 1, we know that revenue is recognized when sales is made or services is rendered rather than when cash is recovered. So when revenue is realized the day when the sale has been done. You have sold the goods, means you have recognized the revenue कि इतनी आमदनी होने वाली है, and not when the actual amount is received or actual cash is received. अब कैश कितना मिला वो रेवेन्यू नहीं है. How much is the total income that we are going to get after completing a particular transaction? That is revenue. Similarly, expense is recognized when a good or service has been used to generate the revenue, irrespective of the fact whether expenses is paid or not. And in the same way, expenses will be recognized when a good or service has been used to generate the revenue. And over here, what has been paid or what is to be paid is not to be considered. Number 2, the expenses such as salary, rent, insurance, etc. are recognized on the basis of period to which they relate and not when they are paid. So all the expenses such as salary, rent, your insurance, they all are recognized on the basis of the period for which they are paid and not the actual amount that has been paid on particular heads of expense. Third, if a machinery is purchased whose useful life is 5 years, then only 1/5 of the cost of the machine should be treated as an expense to generate sales for the accounting period, and remaining 4/5 of the machine be shown as an expense of the next year. So if you have purchased a machine, say the cost of the machine is 10 lakhs and its estimated useful life is 5 years. So divide 10,000, the cost of the machine is 10,000 and the actual and its useful life is 5 years. Divide 10,000 by 5, you will get 2,000. This 2,000 will be said to be the cost of the machine for the expense on the machine that will generate sales for the accounting period, for the same accounting period in which you have purchased the machine, and the rest 8,000 will be for the next periods. And in such a way the expenses will be allocated throughout the life of the machine. Number 4. If insurance premium paid is partly related to next accounting year, the part related to current year is an expense of the current year and rest is the expense of next year. If I say that I have paid rupees 15,000 for 15 months as insurance premium, so in a year there are 12 months and I have paid rupees 15,000 for 15 months. So per month insurance premium comes to rupees 1,000. So for the accounting period the insurance premium is rupees 12,000. 1,000 multiplied by 12. And the remaining 3 months is for the next year. The cost of goods are also matched with their sales revenue while preparing profit and loss account. Cost of goods sold need to be considered cost of all the goods produced less cost of unsold goods, which is stock. So to calculate the cost of goods which to match them with their sales, all the cost will be considered by adding up the goods that have been produced, and we will subtract the unsold goods, that is the stock left from it. Thus, matching concept implies that all revenues earned during an accounting year, whether period or not, and all expenses incurred during an accounting year, whether paid or not, are whether paid or not are matched to ascertain the profit or loss for that accounting year. Need. This concept provides greater objectivity and greater flexibility because assets are recorded at their cost price and not at their market value. So chances of manipulation and window dressing in accounts are remote, as the assets are shown at the cost price and not the market price. So no manipulation in the prices or the book value of the assets can be made. कोई chance ही नहीं. Delay in preparation of financial statement is avoided because assets are shown at their cost price. In contrast, many times it is not even possible to work out market value for certain assets, as the values of these assets change frequently in the market. So, no delay in ascertaining the actual price of the asset. The book value of the asset will be there because the assets are charged at the cost price. What is the cost price? कि मार्केट में जाना है फिर एसेट की वैल्यू पता करनी है, nothing. And there are certain assets where the calculation of the value is impossible because they keeps on changing frequently in the market. The prices keeps on changing frequently in the market. This concept strengthens the assumption of going concern in the sense that going concern assumes that the business will operate its activities till indefinite period of time. So there is no need at all to use current values of the assets. Now, limitations. The biggest limitations of this principle are: number one, the true worth of the business is not shown in the books of accounts, and the business may hide gains had those assets been shown at their market values. Number 2, assets for which no amount is paid cannot be recorded in the books of accounts. Number 3, a balance sheet prepared on the basis of cost concept it does not indicate the price at which the assets could be sold, as against a relevant balance sheet prepared on the basis of market value.